All right. I give everybody a few minutes to get rocking and rolling here and get on, and we'll go. Is that Nikki? Number one as always. What's up? I'm gonna wait about 2 minutes to get a couple people on here, so somebody pays attention. And then I'll get rock and roll. I got a lot of really good updates. Brianna, number two. Nikki's got a faster trigger every single week. Got my wife's mug today. Johnny. All right. So guys, I'm going to get rocking and rolling. We've got a few people on here, and we're obviously going to post all this stuff to our social media. Hopefully you guys, can share it, utilize it, share it with clients, share it with people in your offices, whoever you think it'll help. But, obviously appreciate the opportunity to be on here with you guys today. I am first feeling very grateful. We haven't had an opportunity to do one of these since we did the St. Jude walk run. I just wanted to obviously thank all of you. We posted a couple videos already thanking everybody, but it really means a lot to everybody on our team, and obviously most importantly, the kids and the families of St. Jude Research Hospital. We obviously thank everybody who participated, thank everybody who donated. It was great over the course of the last few months, seeing all the support and all the awareness that was raised for the hospital, and an amazing cause and charity. The Boston Walk, ended up being the number one walk in the country. Thanks to all of you. Our team raised $64,000. So obviously we all know Boston is the city of champions. All our sports team are constantly bringing it in. It's nice to see us take home the gold with the walk, the Boston Walk, for an amazing cause as well. So I'm really proud of that. Obviously in addition to the money we raised, raised a lot of awareness, but obviously just the bottom line is it helps, hopefully eradicate childhood cancer, and, improves research, improves everything, improves lives. So thank you very much. We appreciate it. It's something we've been at for almost 5 years now, and it's something that we're committed to, keep doing. And the more of you that can be involved, the more of you that want to be involved, please reach out to us, reach out to me, reach out to Nikki, reach out to anyone on our team. It's something near and dear to our hearts. We'd love to have you involved. So exciting stuff in terms of mortgage related. I got a bunch of different topics here. So first and foremost, I'll start with the home purchase roadmap. So we have a new home purchase roadmap. The roadmap gives you guys a detailed description of what borrowers can expect from the time they initially call us to the time they find a house and close. Okay, and we outline it, make it very simple to understand. It's a great visual. It's something that we want to get out to our clients, to our referral partners. So if you want a copy of it to give out to your clients or use for yourself, please email me at shant@rate.com or email nikki@rate.com. We will make sure we get it out to you. We have a bunch of other great marketing tools that just provides a ton of infographics, great information that you can kind of see information in terms of like what we predict with home prices, rates, really just great detailed information that clients and consumers can use. So we're here to support our clients and our referral partners. So we're happy to share all that great information with you. Also, in terms of sharing and support, we got some new webinars going. I think, one of our goals going into this year was providing a lot more content for you guys. With COVID, it became even more important as, we see less and less people at their offices, and having the webinar library has been massively impactful. We've been zooming into real estate office, team huddles and all that kind of stuff. We've never done more of that stuff. So if you want us to be a part of it, please just ask. We're more than happy to do it. We have a lot of great content. The content changes every single week in terms of trying to stay relevant. So there'll be a link posted with the video. But upcoming topics, I think this is a super important one. They're both important, obviously, that's why I picked them. End of the year client engagement with Nikki. Obviously this year's a little bit different. There's no holiday, there's probably gonna be no holiday parties or year-end events in person. So join this webinar to make sure you're staying, engaged with your clients. I think it's really important. The dialogue in everybody's minds, our clients, has changed, right? People are, I'm gonna talk about this in a little bit, but they're thinking, in terms of reevaluating their mortgage, their housing situation, their location, all that kind of stuff. So that dialogue's going on, whether we're a part of it or not. I think it's important to stay relevant. I think it's really, really important to stay top of mind. And I think it's very, very important in any type of business, more so now than ever, is to make sure you have a communication plan. How are you, staying in communication with your clients via email, via phone, via text, via messenger, via social media? It's not just about posting once, it's about having relevant content for weeks, months, years, that all is in alignment with each other. So that's what we're constantly working on, and I think that's as any sort of professional, but obviously more focused to mortgage, real estate. I think it's key right now. We're also doing what's new in social media with Brianna. Obviously social media is constantly changing, so tune into this webinar. There's a new Instagram algorithm. LinkedIn stories are also new. I didn't even know about that for a little bit. And then takeaway, you're going to get a downloadable end of the year social media content calendar, I think, we've gotten amazing feedback on for those that have used it in the past, and it's been a key part of what we're able to do. All right, I'll give you guys some, I call it the boring mortgage updates, but obviously they're important. So word on the street is exciting. That hopefully in the next few days, that Fannie and Freddie are going to be rolling back some of the self-employment guideline changes they made post-COVID. There were restrictions. In my opinion, they were overdone. I hated them. I hated them for my clients, and I hated them for kind of just the lack of clarity provided. So hopefully we get some changes there, and we can get some good news out to some of our self-employed clients, and hopefully improve the amount of pre-approvals and loans we're able to do for our self-employed clients almost immediately. So that's a huge relief. Also some big change that happened over the course of the last month. Adjustable rate mortgages, the most popular adjustable rate mortgage was based on a LIBOR index, and that's pretty much going away, and it's being replaced by the SOFR index. Obviously, if you're interested in an adjustable rate mortgage, or you have one and you want to find out more about it, obviously happy to chat with you about it. But to me, it means I think our clients will see more aggressive rates on adjustable rate mortgage options. It does mean that the frequency of the adjustment period is going to be every 6 months rather than every year. So if you're fixed for 5 years, 7 years, or 10 years, after that, the loan can start to adjust. And I think that's when we're going to see, that's when if you stay in the adjustable rate portion of the product, instead of adjusting on a yearly basis, it'll be every 6 months going forward. But, reality is most of our clients tend to either reevaluate their situation before then and either get into another mortgage product. And then the yearly cap is also a little bit more conservative. So typically on some adjustable rate mortgage products, the yearly cap is 2%. That's going down to 1% with the SOFR index. So that's positive news. All right, a lot of mortgage and housing data coming at you right now. So refinance volume surged the highest levels since mid-August as mortgage rates dipped. Okay, refinance jumped 8% last week and 50% higher than a year ago, according to the Mortgage Bankers Association. So the key part of that, it's 50% higher than a year ago, but last year we were in a full-fledged refi boom already, right? Rates had already come down. So it's like, we're seeing massive refinance demand. What we're seeing our clients doing is we're seeing people lower their interest rates to save money. We're seeing people reevaluate their mortgage product to get in line with their life goals in terms of maybe cutting term. I've probably never done more 15-year fixed mortgages in my life in terms of with people having the goal of paying off their mortgage faster and earlier into retirement. I'm seeing our clients pull out some cash. Home prices have gone up. There's no in certain markets and in a lot of markets aggressively. So we're seeing people take money out of their homes and reinvest it in terms of home improvements, projects they weren't able to do before. But now that the value's gone up, they can go out, borrow that money at cheaper rates, and utilize it. And then lastly, we're seeing a lot of clients in the same due to the same reason in terms of home prices going up. If you put down 5% or 10% when you bought your home, you may have been paying PMI or 15%. We're seeing a lot of people have success with not only lowering their interest rate, but eliminating their PMI, increasing the savings. So good stuff there. Applications for purchase mortgages fell a little bit from the previous week. However, also 21% higher than a year ago. So think about that. Mortgage applications up on refinances 50% from a year ago, and 21% on the purchase side from a year ago. So it's October, and things are just booming in the mortgage world. So the annual comparison is strong, but I've been noticing for sure that purchase volume is definitely starting to, as we get closer and closer to Thanksgiving, just like it does every single year, it's waning a little bit now. August and July were insanely busy. September busy. October way busier, 20% busier than usual. It's just getting a little bit slower. By no means is it slow. By no means is there activity lacking. It's way crazier than last year, and it's the craziest fall market that I've definitely ever been a part of. So excited about that. And we have continued to see average mortgage, the average mortgage amount increase as the high-end markets have doing really, really well. So I think from a purchase standpoint, with things being up 20% year over year and inventory also being down, I've talked about that on the last couple calls. I think it just requires that you're prepared as a client or as a realtor and have a plan because not only is the activity up, but inventory's down, so it's cutthroat. We're still seeing multiple offer situations. We're seeing and we're seeing a need for speed in terms of right now we're trying to get everybody in before Thanksgiving. That's what clients want. They want to have that week to be able to move in and prepare and all that kind of stuff. So we're definitely feeling like our processes and our systems are very much able to handle that, and we're here to help support you guys if closing fast is what you want to do. Mortgage rate update. So mortgage rates are, I've been on here for months now talking about how great they are and that they've remained great. So they've been holding steady for the last 3 months at very low rates. I've been talking up the Fed. The Fed's doing an amazing job. They're determined to provide maximum liquidity to consumers and keep mortgage rates low. So the Fed Reserve continues to keep the Fed funds rates low, near zero, and they're buying mortgage-backed securities, which to me offsets all the political and economic shocks we've seen in the recent months. I think the Fed's going to do what they need to do to keep this housing market strong. And I've said it a couple times now. The housing market in the U.S. is the strongest sector in the world right now, in my opinion. What these low rates mean for our consumers year over year. They're saving about on a $400,000 loan. Obviously, in some markets, there's bigger loan amounts or smaller loan amounts. But on a $400,000 loan, our client from a year ago is saving about $150 a month, and they're saving another $150 from a year previous to that. It's also giving them an additional, that's on a refinance. It also, for a home purchase, you're obviously able to, as home prices go up, by rates coming down, it keeps you more competitive. And it also provides you with $35K more in buying power than it did last year. So those low rates are a big key to keeping people in the market and keeping this housing market humming along. I do feel, however, that we're starting to get close to rate spotting them out. We're in the twos right now, in the 15 years on the low twos and the 30 years on the high twos. I do think that, due to capacity constraints across the industry and all this inflation talk we're starting to hear about, I think you'll start to see rates tick up a little bit. I don't think we're going to see anything crazy. I think we're going to be a low rate environment for the rest of 2020, 2021, and probably even to 2022. But it's important not to get lulled to sleep by kind of thinking that rates are going to remain this low forever. I think we'll probably, at some point, jump back into the threes next year. I think it's just important, kind of with what I was saying here, the rate environment presents an incredible opportunity that should be taken advantage of. If you haven't considered a refinance or evaluated your current mortgage, I think you'll be pleasantly surprised by what you can be doing right now. And I think you should be reevaluating, if you're a home buyer, what your budget is in terms of your monthly payment, your down payment, your closing costs. As you're reevaluating kind of where you want to live, whether you want to be a renter, go from a renter to being an owner, or if you want to upgrade or downsize or buy another property, just getting that budget right is really, really important. It's part of the kind of mental preparation for buying a home. My clients are just, every time I feel like I'm going over numbers with them right now, they're always like, wow, I can't believe how low rates are, and wow, I can't believe how low my payment is. Some other economic news. Unemployment report came out a couple weeks back, fell down to 7.9%, so obviously trending back in the right direction. We were at the lowest levels of all time earlier this year at 3%, jumped up to like almost 15%. Every single month I've been on here for the last couple months, I've just been talking about how unemployment's getting lower and lower, and that's obviously the right direction that we want it to be. Hopefully going into 2021, we're back down to like 5 or 6%. They also revised the August 2020 job gains That was up instead of 1.37 million, it went up to 1.4 million. So more good news. Other good news: forbearance had its sharpest decline in 6 months. So it's when a lot of consumers that had homes had the opportunity from mortgage servicers to not pay their mortgage and defer it to the end of the loan. So it's down to 5.6% of all mortgages are in forbearance. Okay, so at the peak of in April and May, when things were we're in the middle of unemployment surging and a lot of uncertainty, that was up to almost over 10%. So it's gone down to 5.6%. I think the big reason that you saw the big dip was because the first wave of forbearance offerings is ending. So in April, when all the programs came out, they gave you 6 months of forbearance as a way to kind of start, and you could obviously have the opportunity to renew it. You're seeing a lot of people just decide to willingly start paying their mortgages, and they have the ability to pay their mortgages as they go back to work. So definitely a good sign. National savings rate. I read an article this weekend in the Boston Globe talking about how the national savings rate is up to historically high levels. I think you're seeing people, travel less, eat out less retail. So, also aided by, government stimulus. Now, that's not necessarily a great thing that people are spending less money, because obviously that impacts our economy and businesses and whatnot. However, I think the silver lining there is that, as I'm talking to my clients, I have clients that are pre-approved 5-6 months ago, a year ago, and when they're coming to me, I'm noticing how drastically different their savings are. And I think what's really important is when consumers are ready to go back to normal and go back to their routines, they're going to have more cash on hand, more of a safety blanket, and I think that's going to help spur things along. So I think it was really, really important. Everybody I talk to, for the most part, is amazed as to how much less their credit card bills are right now. So, that's a good thing, right? In the short term, not permanently. Obviously, we want people to be comfortable spending and supporting businesses, and that's kind of how our world goes around. But I do think there's a silver lining in it that the saving rates have definitely improved, and I'm seeing it when I'm talking to my clients. And then the Dow Jones is almost back up to its matching its the highs pre-pandemic. So I went on this morning to check that out. The Dow's had an amazing run, and the Nasdaq's completely killing it. So that's been good to see. And I'll wrap things up with a quick housing rundown. As I said last time, all our clients, I feel like, are reevaluating their lifestyle, their home, and rethinking their location, right? We're seeing a large segment of our population working from home, transforming spare bedrooms into offices. Renters, can move out to more affordable areas, not restricted by location due to telecommuting. So I think the telecommuting piece is going to change the game in terms of housing. I think that's going to, keep pressure on inventory, because, you're going to see people that don't have to be restricted in terms of renting somewhere to be close to work, and now they can become homeowners, because I think that it is the American dream to own a home, and I think that's really important to people, and I think they're going to have the ability to do that now without some restrictions in terms of having to go into the office, because you're starting to see more and more companies come out. I think Microsoft said just a couple days ago that they're never going to have people come back in, or are not required anyways. We're seeing young adults, a lot of the millennial clients that we talk to, like the younger ones, moving back in with their parents to save money. Once routines go back to normal, that means the down payment ability is going to be there, right? Like, you move home with your parents, save money. One of the biggest barriers to entry into the housing market that I've noticed for first-time home buyers has been the down payment, because a lot of times you come out of school, you pay expensive rent. The fact that some of these people are going to go home while there's a little bit of uncertainty and just save up cash and be able to use that to prop up the housing market and get into the housing market, I think is going to be really, really important. We've definitely seen some urbanites, leaving the big cities. I've seen, talking to my clients in Manhattan, in San Fran, in a lot of cases in Boston, we're seeing them push out to the suburbs more, or if they're electing to stay in the suburbs, buying second homes in markets where they have an escape, somewhere to go to kind of be able to be outside. We're also, I also think the urbanization of the suburbs has greatly helped. The ability to kind of, a lot of these suburbs have really transformed over the last 5 or 6 or 10 years even, and become destinations for people that don't need to live in the city or don't want to live in the city. And I think that's a very big key into what's going on right now, because you get a lot of the amenities that used to only be available in the city, and a lot of the suburbs have really kind of, without knowing, are prepared for something like this. Home builders, I'm seeing major confidence amongst them. Obviously they're having some challenges in terms of like lumber prices, and the the supply chain being disrupted due to Corona, due to some of the fires out west. But they're definitely capitalizing on the opportunity with single-family starts climbing to pre-pandemic levels, right? So that shows confidence there, and it's I think construction is a massive, massive part of helping the inventory issue because they're not there's not more land coming, but hopefully if they can find land to build houses on, I think that definitely levels the playing field from an inventory standpoint. I don't know how else inventory kind of fixes itself without new construction playing a big part of it. And then we're seeing our clients, vacation and retirement home markets are surging. I'm talking to my, we do, obviously being in New England, we do a lot of business in places like New Hampshire, Maine, Vermont. The agents and the attorneys and title companies and insurance providers, they're completely maxed out. They've never seen demand like they're seeing right now. Other markets, Aspen, the Hamptons, Palm Beach, like luxury markets are seeing massive demand as people, I think, have just come to the realization they're maybe not going to be vacationing as much over the course of the next 2 years or whenever this ends, and or maybe permanently, who knows. But kind of redeploying that capital into a second home and a place to go for them and their families, especially with the opportunity to, telecommute, work from home, working from a vacation spot, maybe is a little bit more appealing to some people than working from your primary residence. So having, that's definitely playing an impact in those markets. Everything I'm reading about the second home communities, especially in the luxury markets, is definitely surging there as well. And then, I saw a report from a company called Veros Real Estate Solutions yesterday predicting 5% home price appreciation in 2021. They think, all the data, everything that I'm reading, CoreLogic, Veros, there's been a couple other ones, housing will stay strong in the next year. It's just where people are comfortable, and it's really, really important. It's top of mind right now, and there's massive demand for it. New home sales numbers at a big jump in 2020, and I think there's going to be even more growth in 2021. I think low rates are going to play a big part of it, and the mindset of our clients. However, the big challenge is going to be inventory, and obviously, what happens with COVID and our economy. I think there's going to be, it's not reasonable to think that it's just going to be a one-way increase in terms of the market. Like, I definitely think we're going to have some ups and downs, but hopefully, we get through that stuff and persevere like we tend to do. But I think getting that inventory, I think the inventory challenge is going to be key. So I think it's important to know this information. I think that, we're here to help you in terms of, preparing and planning. That's a big key of what we're doing. And we want to help you be part, we want to help you prepare to buy that home, upgrade, second home, investment property, primary residence, whatever it is, and just answer your questions. That's what we're here to do. So I hope everyone's staying safe and healthy, and hope you guys are all getting ready for Halloween. To all you parents out there with kids in school, hope that's going great as well. And your kids are getting the support they need to thrive in that environment as well. So I hope you guys have a great rest of your week. Talk soon.